Hey, how about that? The stock market does know how to go up. All joking aside, of course, things have been pretty difficult here lately. So it is nice to find a little bit of green here every once in a while. The S&P 500 was up 1.65% today. We had about 83% of the stocks in the market closing higher, and that was largely because there was finally some positive sentiment within the financial sector. Of course, the big news over the weekend with the bank failures put a pretty disastrous exclamation point on what has been choppy trade so far here in March. So today the bargain hunters were out. They were looking to see if there were any babies being thrown out with the bathwater. We saw a number of those banks snapping back to a pretty aggressive degree. However, it's not all roses. We did find a number of charts where there were some long upper shadows of stocks and other asset classes like Bitcoin closing well off the highs of the session. So that doesn't necessarily give you the warm and fuzzies heading into tomorrow's open. But hey, we'll take what we can get at this point with some bullishness finally entering into the system. So we'll talk about all that in tonight's video. We'll see how that affects our postures across the major market indices. We'll also take a look at our macro charts and also some sector analysis in tonight's video before getting into our trade application example where I wanted to add some bearish deltas to our portfolio, and I did a bear call spread on a technology stock that is directly involved in the financial sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 14th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter, and if you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, looking pretty good for the bulls today. I know St. Patrick's Day is not coming up until Friday, but this is starting to look like the Chicago River here in front of us. A nice healthy bounce back day here today. Now we'll take a look at the charts a little bit later, and we'll see that maybe there are some things that we could poke holes into, but let's be thankful at least for one day that we didn't have kind of an avalanche of selling like we've been used to here recently, mostly as a result of what's been going on with Silicon Valley Bank, and of course following on to that, Signature Bank, and of course even before all that was Silvergate Bank. And so we've been dealing with some potential domino types of effects in the banking system, which, as you've heard me say fairly regularly in the past, is the lifeblood of our economy. Without the banks, things just are not going to be working the way that they should. So in one way or another, we should all want this to get resolved in an adequate and fair fashion. And of course, that can be argued depending upon your viewpoints. But point being, it does look like the regulators are stepping in. They're trying to protect the interests of the deposits without giving the impression that they're actually bailing out the shareholders. And I think all in all, that's probably the right way to handle it. Obviously, if you found yourself on the wrong side of those trades, you will likely disagree. But in general, it was enough to calm the markets down because we did get to a point here within the last week where things did get chaotic. They felt different. They felt ugly. They felt like things were breaking behind the scenes, and that's kind of starting to give you the impression of an uncontrollable situation. And you just never know when we start rolling the ball down that hill what turns into something like an 0809 or a dot-com bubble or something like that where things get really, really ugly in a hurry. So again, I don't think we're out of the woods here. But it is nice to know that there are still some people willing to buy stocks out there, as evidenced by all of this green on the board here today. So didn't really see much in the way of red out there. There were maybe a few more red spots showing up here in the healthcare area. Some of you saw me tweeting about Bristol Myers Squibb here today. I've been tweeting about Pfizer more recently as well in regards to where they're showing up on the dividend stair-step charts. Also J&J, I did that I know a week ago. So all of a sudden I have a lot of those healthcare companies directly on my radar as a dividend growth investor. Many of them are substantially out of favor at this moment and actually approaching levels that are quite attractive, at least by historical standards. Whether this time is different or not will remain to be seen, but what I can tell you as somebody who's taught dividend growth investing for the better part of the last 8 or 9 years, generally speaking, it has been difficult to lock down the highest quality healthcare companies at attractive points, especially all at once. You know, every so often you get one stock that falls out of favor because they have a bad FDA announcement or something like that. But this has been a bit of a peculiar time here recently where some of the best cash flow types of businesses out there that have been willing to deploy their capital to shareholders through the forms of dividend increases year over year for extended periods of time, many of them are showing up at attractive levels altogether here. So it's kind of one of those when it rains it pours types of moments. So we have been concentrating a lot of our efforts in both my dividend growth investing class and also my Monday afternoon options for long-term investors class by selling puts on a number of healthcare companies as well. So it's been a little bit more interesting, at least to me, from that perspective here recently. And some of those were again out of favor here today. You can see Amgen was down, CVS was down, Cigna was down, CNC and Molina were down. Looks like Medtronic was down just a touch. So if there was any kind of more consistent selling, it seems like maybe a little of that emerged there in healthcare. But of course, most of those still did close in the green. So it wasn't as though it was a bad day for healthcare. It was just that there was more red squares within healthcare than in many of these other sectors that are out there. I do see that there was perhaps a little bit more red squares over here in the consumer discretionary area as well. Home Depot and Lowe's both finished down ever so gently here today. We did see General Motors, Ford, Dollar General, Dollar Tree, they all closed a little bit lower there today as well. So maybe a few more of those red squares showing up there in consumer discretionary as well. But generally speaking, you can see that it was real hit and miss. We've had a lot of those types of days lately on both sides of the equation. We've had a lot of really one-sided sell-off types of days. Remember last week? We had several of those. In fact, some of you saw my tweet on Friday afternoon in that regard, where 3 of the days last week in the S&P 500, we had more than 90% of the components in the red. And that was on Tuesday when I believe there were 94% of the components in the red. On Thursday, I believe there were 95% of the components in the red. And then on Friday, it was something like 92% of the components were in the red. So you don't see that all that often. And again, it's largely because of all the controversy around the banking system and what to do about it and how to try to prevent contagion and how to make sure that this doesn't spill over to other banks that maybe some of you are doing business with. Maybe some of you have actually been having those conversations with your spouses or business partners or what have you here recently about where do you keep your excess capital? You don't want that to be at risk. And so have a feeling that that's happening across the board here. And hopefully today calms a few of those nerves down. There were a number of financials that snapped back quite aggressively. Schwab was up quite a bit here today, is up 9%. Their CEO was on CNBC earlier today and said that he actually bought 50,000 shares of Schwab for his personal account here either this morning or yesterday afternoon or whenever it was. The stock was already up by the time he said that because the whole market was in rebound mode from pretty much the get-go this morning. Remember, we did have that CPI number. It basically came in as expected, so it didn't derail whatever the market had thought about it previously. So Schwab and a lot of the other banks were already up, but maybe that kind of confirmed that those that were buying Schwab stock were doing so with the knowledge that even the higher ups within the business itself were also trying to take advantage of the market's recent dip. Whether that lasts or not is anybody's guess. I think, as I mentioned before, we're still a long ways away from calling this a done deal, where everything is, peachy keen going forward once again. I think we're probably going to see a lot of volatility from this point forward. You'll also see that there was this little stock here called First Republic Bank San Francisco. This one has kind of been caught up in the firestorm here recently as well. You'll notice that it was up 26% today. That was actually the best performer in the S&P 500. But remember, that was one of those companies based there in San Francisco, not too far away from Silicon Valley Bank, that absolutely got crushed last week alongside many of the regional banks. It's been kind of amazing to look at. Remember last week we brought up that chart of KRE, talking about how it suffered its worst day in years and even its worst week in years. So it's not that First Republic was alone. Most of the kind of smaller banks outside of the big four have torpedoed lower over the last week, but they in particular really got hit. And it was kind of touch and go there. I'm sure there are some people trading it bearishly right now, thinking that it's destined to go to zero, just like Silicon Valley Bank was. But today was a snapback day for those that were in bargain hunting territory, sending that stock back higher once again. So it's not every day you see a bank up 27%. When there's really not any news specifically about that bank. It's just simply because it had torpedoed lower so aggressively. Wells Fargo catches my eye here as well. Of course, they're not a regional bank. They are one of the big four here in the United States. And a lot of people are saying because of this banking controversy and how it got handled and how, FDIC insurance doesn't cover balances beyond $250,000. Of course, there are some exceptions to that rule depending upon how you set it up and whether you have a trust or a spouse or what have you. But the main point being that there were a lot of people that got caught flat-footed with this Silicon Valley Bank situation. And, a lot of people had said that a lot of money is now pouring out of the regional banks from a deposit perspective and heading into the big four, JP Morgan, Bank of America, Wells Fargo, and Citigroup. Well, Wells Fargo snapped back today as well. It was up 4.5%. However, an interesting news story did catch my eye after the bell here tonight, when Wells Fargo came out and said, hey, we're issuing a shelf offering, basically raising capital. And typically you don't see businesses doing that unless they think they need to tap into that capital. So that was a little bit of a head scratcher, considering most people said that the big banks are in great shape right now. And if anything, they're probably benefiting from all of this chaos with the regional banks. Yet Wells Fargo's just not going to, play any games at this point. I'm sure they still have war scars for what they went through along with the rest of the banking sector back in 08, 09. And they're like, we don't want a repeat performance of that. We want to make sure we have tons of liquidity at our fingertips if we need it. So we'll see how the banks trade tomorrow based upon that news. But I did find that to be a little bit peculiar, to say the least. We also saw that Tesla had a big day. It was up 5% here today. NVIDIA had a big day. Of course, ChatGPT was the big story before the banking meltdown. And I did hear that they're issuing kind of an upgraded version of ChatGPT. So Microsoft was also up. Microsoft has actually been looking pretty good on the charts here lately. In fact, it was one of those stocks that I had written down as a potential trade application example for tonight's video. I opted to pass on it eventually, but I do think that it looks pretty strong. So if you're looking for a bullish trade idea, Microsoft could very well get you done at the moment. I opted to go with a bearish trade idea that I'll share with you a little bit later in tonight's video. But that one has been firming up quite nicely here recently. Also, I should mention Meta had a great day. Remember, this is the old Facebook, and this stock was up 7% today. Meta's had a great year and a couple of months, but today it was spurred on by yet another announcement of slimming down the workforce. It seems like they constantly are getting rewarded whenever they hint at cutting jobs. And so no surprise they continue to do it. You can't hold it against them. Obviously, if you're somebody that lost your job, you're not feeling too great about that conversation. But the stock market or the shareholders are getting rewarded, because I think the general impression is that the tech industry got too bloated over the years. They were flush with cash. They were hiring as many people as they could possibly hire in a short amount of time, and then realizing after the fact, you know what, we probably don't need all of these people. And they're starting to, tighten up the purse string, so to speak. And so the stock market is applauding their more disciplined approach here more recently, where layoffs typically mean cost savings, and as long as the overall business and its services don't get negatively impacted by that, that is a net win in shareholders' eyes. And again, I hate to sound so cold-hearted about that, but that is capitalism at its finest, right? That is what we are all involved with when we enter into the financial arenas. And so those decisions do need to get made occasionally by companies who can get away with it. Remember, there's probably a lot of other companies out there that are already running so efficiently that they really can't afford to let go of a whole lot of their workforce. But the tech sector in particular, I think, is kind of your prime target of where you're going to see a lot of those layoffs. Remember, from a private sense, Twitter is now a privately held company, of course, with Elon Musk at the helm, and he gutted that company. I can't remember what the exact numbers were, but it was a substantial amount of the workforce that basically just disappeared within a few months. Yet Twitter is still up and running, and pretty much running as it was prior to all of those layoffs. And so Meta is probably looking at that from the distance and saying, you know what? We could probably do the same type of thing, maybe not to the same degree, but certainly we could let go of a lot of our workforce and start making shareholders more profits in the future and running our business more efficiently than what we've been used to in recent years. So I would expect that that trend is likely to continue into the future, especially given the fact that the stock market seems to be applauding that type of a decision. So anyway, that was kind of interesting today as well. So all in all, a great looking heat map for us here today as a nice snapback type of a rally. Let's go ahead and get some official numbers now from our main part of our platform. You can see that 417 stocks in the S&P 500 managed to close in the green today. That was good for about an 83% hit rate. Now, 83% on the positive side of the equation does not match the 90% plus down days that we had last week, but it's a start, right? Again, it's a sign that the market is not just going to completely roll over and just trap you in it, right? There are going to be moments where if you think that the trend is now more bearish and likely to continue bearishly, that there will be moments where you can try to get out of some of your bullish deltas. So today could have very well been a day like that for some of you, where you felt like things spiral out of control much more aggressively than you assumed last week, and perhaps you got stuck in some positions that you didn't really particularly care to be stuck in. A day like today, a snapback type of a rally, is one of those days where you can try to start unloading some of your merchandise at more favorable terms than would have been the case just, yesterday or late last week. So a good day there for the bulls, but obviously they've got a long ways to go to make up for last week's losses. Let's go ahead and take a look at our charts now, and as you can see, I've got chart 6D pulled up here in front of us. 6D is the chart that I like to start our conversation off with when we have a move of at least 1% either up or down. Today, of course, was a 1% plus move, the kind that the bulls enjoy. You can see how that looks on our chart here with the green line going up and over this blue horizontal line, kind of giving you the impression of how aggressive or not the market has been lately. And quite frankly, this is not as aggressive visually as the way it feels to me as somebody who has been participating in the market lately. And really, that's the whole point of looking at the charts. So that way you can, correct for situations that you may be misinterpreting. And I think the reason that my mind feels like it's been much more aggressive here lately is because it has really cratered one important sector of financials, and that's where all of our eyeballs are directed to right now. And we see the pain of banks going down 20% a day only to snap back 15% the next day. It feels like it's trading a much more aggressively out there. But the truth of the matter is, when you're looking at the S&P 500 and looking at this activity here lately where it feels like we're on a roller coaster, you could compare it to what we were doing just last fall. And last fall was worse, right? What we were dealing with back in late September and into October, these were much more aggressive bars on this graph right here than what we've been dealing with in the last week. I don't want to belittle it, because obviously some people have learned some very painful lessons with the banks that have gone under and things like that here recently. Maybe some of you were on the winning side of that trade, by the way. We didn't have exposure to any of those banks in any of my 5 classes at Market Scholars or here in the Market Outlook category either. So I was just kind of an interested observer from the sidelines more than anything. But some of you were trading those stocks, and some of you maybe learned a painful lesson holding a stock that went to zero. Others said, holy mackerel, I bought puts on a stock that went to zero. My life is golden right now, right? So there's winners and losers, as there always will be. But, in that particular area of financials, there has been definitely much more aggressive trading than we have seen for a long, long time. However, it hasn't necessarily translated to much more aggressive trading in the S&P 500. Remember, these days, the technology sector is much more influential on the overall market than the financials. And so, in a way, when we're looking back at the last 2 big market meltdown time periods of 08-09, and then also before that, the dot-com bubble era, currently the market would be much more damaged if we were going through a dot-com bubble implosion type of a scenario, as opposed to the banking meltdown that we saw in 08-09, because the dot-com implosion would have been directly impacting the technology stocks, and the technology stocks are currently the ones with the biggest market caps that have the most influence on the S&P 500. I'm not here saying that it couldn't be just as painful to have a banking meltdown, because eventually that will catch up to pretty much everybody. But just telling it how it is, as far as if you felt like more recently we've had some of the most aggressive trading back and forth, and then you look at this and you see that that's actually not true, then that could explain what's going on a little bit more simply. The tech stocks have not been particularly hit the way that the banks have. The Microsofts of the world have held up just fine in the last week. So has Apple. And so that's really offsetting the extremely aggressive, like 50 and 60% meltdowns that you're getting in kind of mid-sized banks that are taking place out there. All right. And by the way, the VIX did fall today. I had mentioned on Twitter yesterday that the VIX did get above 30 once again. Now, you don't see it here on this graph simply because this is just looking at the end of day prices, but I could show you here to confirm it by pulling up the VIX on the top chart, on the price chart here. And you can see that yesterday morning at the high, the VIX was at 30.81. And it's not that that is like, the most ridiculous number you'll ever see. I'm not trying to make that point. But remember, we were just talking about last week how the VIX was below 20 and how it required an effort just to get back to 20. And it was peculiar because some of those days were sell-off days. And I was scratching my head like, why is the VIX not moving? Well, this just goes to show you that when the VIX makes up its mind, it can do so in a hurry. Whereas once it felt like it wasn't moving, then it started moving really aggressively once fear truly did hit the system. So yesterday we did get above 30 on the VIX. Now remember, last year we had a couple of different periods of time where the VIX was up here at 35. So even from that perspective, the VIX again did not seem to, have some sort of a feeling of black swan type of an event with this banking meltdown that we've seen here recently. But the VIX is again tracking the S&P 500, right? If you use the VIX specifically on the financials, I'm going to guess that those VIX levels specifically on the financial sector were higher than what we saw last year. But on the overall market, it was basically still lower than where we were last fall and also at the beginning of last summer. But at least we got to elevated levels for once. And so maybe that was an opportunity to do some selling of premium while those contracts were nice and juiced up by higher volatility. But after today, of course, the stock market had a big 1.65% rally, and therefore the VIX turned around as fear is leaving the system to a degree, and it ended just a hair below 24 here today. So we went from 30 at the open yesterday when people were pulling their hair out to now ending at 24 at this moment. And I would say that's a pretty reasonable number. I felt like last week when we were below 20, that was not reasonable. To me, it felt like the VIX should be higher than that. You could probably get away with saying that yesterday morning above 30 was not all that logical, but I think where we're at right now at 24 seems about right to me. Not that I have a great feel for that sort of thing, but it does kind of feel like that's at least a more normalized volatility environment that we're dealing with here. Remember, that's usually a good thing for traders. I know a lot of people, detest volatility because it usually comes with panic and people making emotional decisions and things like that, which usually doesn't work out the best for people. But for traders, you need a little bit more activity. Like I was mentioning to my students here this morning in my DGI class, I've actually found it to be interesting to be involved in the markets here over the last week. Right? I've been learning things that we really haven't talked about in the past, how this bank run was tremendously different than what we experienced in 08-09. So just from an educational perspective, I found it to be a very interesting time to be part of the markets, even if it hasn't always amounted to big gains or anything like that in my portfolios. It's been interesting, right, and educational. And I think there is value to that because the more educated you are, hopefully the wiser you become, and hopefully the more confident you'll be making better decisions in the future because you've lived through this moment, right? So if you've suffered some pain here recently, don't forget that element of it as well. Keep your head up. We've all gone through difficult periods, and it's what you learn through the difficult periods that ultimately dictates your future success, as long as you're not willing to give up. And I think many of you have the spirit of pushing forward and giving it the old college try. And that's why a moment like this is best that you don't just put your head in the sand and hope for the best. Try to learn from it and try to improve upon what you were doing already with the knowledge that you've gained about what's been taking place here more recently. Let's go ahead and get into our foregrid now. And this is chart 4B for those of you that are following along at home with your Premium Market Scholars package. And this is just our foregrid that will look at the 4 major U.S. equity indices and give us a very quick way to determine what the postures are according to the Market Forecast Technical Indicator. And so you can see I've got the S&P 500 in the upper left, Dow Jones in the upper right, NASDAQ Composite in the lower left, and the Russell 2000 in the lower right. And as you can see, all 4 of those charts continue to have a dark pink background color, telling us that the posture continues to be strongly bearish despite today's snapback rally across the board, right? And it was pretty nice for all of these indices. All of them were up at least 1% here today. The S&P 500 was up 1.65%. The Dow Jones was up 1.06%, so it was our laggard here today. The NASDAQ Composite was up 2.14%, so it was our leader here today, with stocks like Nvidia and Microsoft and others, doing nicely there in the tech space. You could throw Tesla into that conversation as well. And then you've got your small caps in the Russell 2000 that were up 1.87% today. And that has been a very interesting story here lately as well because of how quickly the small caps have fallen out of favor. It was not too long ago, just a month ago, where they were our leader, but they fell out of bed dramatically. Remember, there are a ton of small banks out there. A lot of people don't realize it. Some of you know that in my dividend growth investing class, we're oftentimes using what I refer to as the CCC spreadsheet. And basically, that's a spreadsheet that has about 700 companies that have raised their dividends for at least 5 years in a row or more. And one of the educational points that I always like to make sure people are aware of is that of those 700 stocks on that spreadsheet, there are about 200 and call it 20 or thereabouts, somewhere in that vicinity. I don't know if that's an exact number, but it's above 200. I know that. And I think it's less than 250. So somewhere between 200 and 250 of those 700 companies are in the financial sector. And you're thinking to yourself, well, how could that be? You know, how could there be hundreds of companies that have raised their dividends when you can probably only think of a handful off the top of your head? Because naturally, us humans, we think of the obvious ones out there, right? Your BlackRocks of the world, or maybe your Chubbs or your Aflacs, or maybe your Allstates, or your Travelers, or maybe your JP Morgans or Goldman Sachs. You know, you're thinking of those big names and you're thinking, how can there possibly be hundreds of financial companies? And the truth is, beyond those big obvious names, there are literally dozens, if not hundreds, of small banks that you have never heard of. And even I haven't heard of. Some of them hardly even trade at all during the day. Some of them might only have like 5,000 shares traded per day. So there are a ton of banks in the Russell 2000 and in the small cap universe in general. And so that's a big part of the reason why you are seeing a chart that looks like this all of a sudden, because that is a bigger allocation for small caps in the financial sector than what you're going to find in, let's say, the NASDAQ composite. So that's been a really kind of interesting side story there as well. In fact, you can see that just yesterday, you had an oversold cluster signal on the Russell 2000. I'm sure David probably brought that up with you guys in his video yesterday, but just to confirm it here, you did have back-to-back oversold cluster signals. For those of you that are newer to this video, what that means is, let me right-click here, maximize this. Notice that down below we have our market forecast technical indicator that comes on the Thinkorswim platform. And when we have the green line, the red line, and the blue line in the low reversal zone on the same day, low reversal zone on the market forecast indicator is 20. So if all of those numbers are below 20 on the same day, it forms what we refer to as an oversold cluster. And it plots this little dot on our charts for us, both here down below on the indicator and then with the corresponding price candles up above. So it basically tells you that, hey, things have gotten really out of control. Selling is aggressive at the moment, and there's a decent chance for a snapback type of rally. Now remember, that does not necessarily mean that we go back into a bullish trend. It simply means things got a little bit too overdone in the short term, and there's a decent chance that we need some sort of a reversion to the mean to correct for that. And so that's probably what we received today. However, when I look at today's candle, I don't know how enthusiastic I would be about looking at this at the moment. And the reason I say that is, notice that long upper shadow there on today's candle. While the bulls would say, hey, you got yourself a nice Cahold pattern here, because that's true, with Cahold being an acronym that stands for close above the high, the low day, with yesterday being the low day. Today we did close above yesterday's high, so that is true. And it was a nice overall net result of 1.87%, right? You're not going to throw a day like that away. That's a good, solid day for the bulls. But the problem is, things looked a lot better earlier in the day, and the bears were still sitting there willing to step back in when appropriate, and sold off this candle from its highs of the morning, where it reached as high as 1802 and sold it off all the way to 1776 by the time it was all said and done. So that leaves a little bit of a bad taste in your mouth there, right? If you wanted a really sharp snapback type of a rally, you want a market that is basically closing at its highs. Just like the bears over here were very enthusiastic seeing this candle because you closed at your lows, right? And the lower you closed near the lows and the close of the day, the more bearish the market would be, or at least that's the assumption. And then likewise, the flip side of that conversation is when you're, like over here is a good example. At the beginning of the year, Small caps were just firing on all cylinders. Notice like on this candle, we closed near the high of the day. This candle, we close at the high of the day. This candle, we close at the high of the day. This candle, we close at the high of the day. You could sense that the market, the bulls of this particular market, the small caps, meant business. This was not just some sort of a random set of 5 or 6 candles here. They were aggressive in their desire to continue to buy stocks at ever higher prices. So it does work both ways. And you'd like to think after the absolute collapse of the small caps that you saw here over the last week and a half, that the first snapback type of a day would be one where you close near the high of the session, and you didn't get that today. So, I still remain a little bit cautious. Now, that's my personality in general. I have a little bit of a paranoid personality. I'm never a guy that's like all in or all out. You have to take whatever the market information is and try to, walk away with, a logical, reaction to that without getting too giddy on the upside or on the downside. But just to be objective with you today, yes, the market's had a good snapback rally and I'm happy to see it, but this is not a great look, right? Where you're not closing anywhere near the highs of the day on what should have been the most aggressive of any sort of a snapback type of a move. And really that was the case, not as aggressively on the others, but you can see that there are upper shadows on all of the other 3 candles. It's a little bit less obvious there with the NASDAQ, so it did the best in that regard. But you can clearly see it with your own naked eye that there are upper shadows on the S&P 500 and Dow Jones there. So again, that kind of puts a little bit of a wet blanket on today's move. Don't want to take it away from the bulls because you deserved it after the shellacking that took place last week. But are there some things that we can, poke some holes in? I think there are. So I would say we're still in a mode of treading cautiously. I don't think the regulators have actually solved our problem yet. And therefore, I would expect more choppy days in front of us, but our posture remains bearish. So in general, until we see otherwise, then these snapback rallies are days where you're thinking about lightening up on your bullish positions and or adding to your bearish trades along the way. At least that's the way that I see it. Okay, so that's where we stand for the moment. We do have red moving averages on 3 out of these 4 charts as well. And remember what that means is price is below a falling moving average. With the NASDAQ, they are the exception to that rule because their moving average right now is yellow. And the reason for that is price is below the moving average, but the moving average is going up just a little bit. But you can see that just yesterday it was red. So it would be very, very easy for that to go back to red as soon as tomorrow if we had another sell-off day. So we're kind of in a precarious position there where that moving average has been kind of changing its colors repeatedly here within the last couple of weeks. So I don't know how much I would trust the current color to stay the way that it is, right? What we can see is that it has been more consistently red for the S&P 500, for the Dow Jones Industrial Average, and for the Russell 2000. So, in general, you go with the majority. And in this case, the majority is saying it has been more consistently bearish out there. Okay, so let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these free presentations that you find either on YouTube, for some of you that watch us there. Otherwise, some of you might also watch us for free over on the Market Scholars website. But either way, I appreciate those of you that go out of your way to help support our presentations, and thank you for supporting David as well. I know he was excited to get up and over 100 likes here the other day. Please continue to do that. Remember, I will actually be out of the office this Thursday. I mentioned that to you guys last week already because I don't want to surprise you, but each year during March Madness, I do jet out of town and try to enjoy some good old-fashioned college basketball and watching it with a group that has done it for quite some time. In fact, I was thinking back that I've gone to a March Madness event every single year since 2004, with just 2 years being the exception, and those 2 years, of course, were the COVID years. And that actually exceeds my annual ritual of going to the Berkshire Hathaway meeting, which I started in 2005. So both of those things I look forward to every year. And those of you that have gotten to know me over the years know how excited I get about those two events, both of which the only break in the streaks are as a result of a global health pandemic. Otherwise, you can't keep me away. So I appreciate you guys' flexibility in allowing me a day off here later on this week. So I won't be doing the video on Thursday. I doubt David will either. Remember, he'll do it on Wednesday and on Friday for you. But I will not be doing the video this Thursday as I will be out of town. But I will plan on getting back and doing the video the following Tuesday. So basically a week from today, I'll be back in action for you guys here. I'll also be doing my premium classes next Monday for those of you that are premium members of Market Scholars. So really it's just one day that you will see me missing from a presentation perspective there. Nonetheless, I appreciate those of you that went out of your way to help support me, which is why I'm giving you a full-length video here right now, because over 100 of you clicked like for me. And anytime we're up and over 100, I'm happy to do a full-length one for you. Remember, if you prefer the shortened 15-minute versions where I don't give you a trade application example, then don't click like. And if we're under 100 likes, then I'll just plan on keeping it nice and short for you the next time around. So let's do some shout outs here. Thank you to Brandon, thank you to Teddy, thank you to Stock Market Junkie, and to Gerald, and to John, and to Ryan, and to KD, and to Ray, and Scott, and Arun, and Tao, and Jeff, and Sarah, and Sonia, and Fun Jonesy, and Ale, and T-Fib, and Roger, and Juan, and Vivian, and Roger, and Ayakipa, and Dave, and Doug, and Valerie. Can't get to all of you here, but I like to at least throw some shout outs to you every so often. Maybe it's fun for you to see your name in the light, so to speak. So thank you again. It means a lot to both David and I when you can do that, because it's our way as a small business to get the word out about our business without us having to spend a whole bunch of money on an advertising or marketing budget. And by the simple ability of you to click like on social media, that allows our message to get out to a wider audience than it would otherwise. So I know it only takes you 5 seconds, and you probably don't think much about it, but it is meaningful to both David and I. So thank you, thank you, thank you to those of you that continue to commit to doing that every single day. All right, let's also have a little chat here about the sector selector. Remember, this is updated on our website on Friday evenings typically. Now, just as a heads up, again, I'll be out of town this week, and since I'm usually the one responsible for doing the sector selector and also the stock selector tools, my plan right now is that I should be back Sunday night from my trip. And so as long as my travel plans go smoothly, I will plan on doing the sector selector and stock selector this upcoming weekend on Sunday night as opposed to Friday night. I figure it's better late than not getting done at all. So again, with me being out of the office, it's a little bit more difficult for me to get the tools and everything required for putting this stuff together while I'm on the road. Nonetheless, I will do my best to get that done on Sunday night at a minimum for you guys. But from last weekend's, you can see that we did have the industrials staying up here at the top for the 3rd straight week. So that was not a big change there. Remember, the industrials are where you're going to find those military contractors, and they did firm up a little bit last week, even when the rest of the market was torpedoing lower. And so that might have been part of the story there. It's not a huge part of the story, but at least one element that's at least hanging in there reasonably well. Consumer discretionary, which was number 2 last week, did slip a spot, and we did start to see some of those travel-related names starting to get hit a little bit. And notice that consumer staples went up. A lot of people like to compare consumer discretionary to the consumer staples to get a feel of what the risk appetite of the market is at any given moment in time. Generally speaking, when staples start improving and discretionary starts kind of sliding or detracting, that's not a positive sign for the overall market. Generally speaking, market participants hunker down in the old school types of companies like Coca-Cola, and they stay away from, the more exciting plays in consumer discretionary, like the electric vehicle companies or something like that, right? So that's what we saw as of Friday night. But remember, this does not include information that's taking place today, so maybe that would not be the case here after Tuesday's snapback rally. But that's why it's important to keep our eye on this story as the weeks go along. Consumer discretionary right now at the number 3 position is actually at its worst positioning since the beginning of the year, right? We started January 6th with the first reading of the year with consumer discretionary at number 2. It then went up to number 1 for the next several weeks, slipped down to number 2, and now number 3 is its worst position for this calendar year. Late last year, it was down here kind of in the middle of the rankings a bit more, but there is some slippage taking place there. So, keep your eye on those types of stocks if you've got some trend trades going on them or what have you. We did see technology improve. I found that to be kind of fascinating, right? With last week being an aggressive sell-off week for the market, you might have assumed that technology would have done poorly. But as I mentioned a moment ago, if you look at the charts of Apple and Microsoft, you don't really see much of a dent in the chart here over the last week. They've held up pretty darn well, all things considered. It's really been more of an isolated conversation to those financials. And speaking of which, look at how the financials look on the sector selector. They have absolutely torpedoed lower. That is fairly rare for the financials. We see that type of behavior much more often with the energy sector. There you have a much more correlated group of stocks that are combined for the sector. But the financials are actually a fairly wide-ranging sector because a lot of times your banks and your brokers and your insurance companies and your asset managers, they all are kind of driven by different dynamics, and they're not always kind of going in the same direction with one another. So it's a little bit harder to kind of push that sector around aggressively. And that's what we're witnessing right now. It's one of those rare moments where that is actually taking place because of the fear that has entered into that particular sector. So we fell from number 6 the previous week to number 11 as of Friday night. But remember, we already got a heads up the week before that, before anybody knew about this whole Silicon Valley Bank situation. We already saw the financials go from number 3 to number 6. I even talked about that with you guys last week when we reviewed this together. So there was some knowledge in price telling us through the selling of financial stocks that there was something amiss in the sector. And then we all woke up to exactly what that was over the weekend when the feds basically shut down Silicon Valley Bank, in addition to Signature Bank, which was kind of random as well, where they kind of just like threw it in for good measure at the end of their press release, which I don't think a lot of people were expecting. So an interesting weekend to say the least, but you can see clearly here the financial stocks from a price perspective are woefully out of favor, and it happened in a hurry. Now, at some point, they'll base and they'll start looking like an opportunity for the value hunters out there, and that will eventually find the financial stocks rising again. But usually this is not something that is going to be corrected immediately. It could, anything's possible in the market, but I would not personally anticipate that financials will be out of the bottom spot by the time that I am going to redo this graphic here this upcoming weekend. Watch the market make a fool out of me and just have those financial stocks ripping higher from here until Friday. But that is not what I'm anticipating right now. They could very well go up between now and Friday, but I'm not anticipating an aggressive enough movement out of the financials where they will actually move off of the bottom position here next week. Maybe in a few weeks from right now, we could talk about that possibility. But right now, the damage was so aggressive last week that even if we get a snapback this week, it won't be enough to get them off the bottom of the rankings, in my opinion. But we'll all find out together here as I get the new graphic put together next weekend. All right, let's get back on over here to the main charts now. Take a look at some 12 grid analysis, starting with chart 5A. Today, let's do something a little different and talk about Bitcoin. Usually I position these 12 grid analysis starting in the lower corners because that's really what's been driving activity. But Bitcoin has been extremely interesting here in the last week. You can see here that we're well off of today's highs. I think it was above 25,000. In fact, it might have been up to 26,000 at one point. So it does have kind of that ugly, long upper shadow look to it, similar to what we saw on the Russell 2000. Nonetheless, I don't want to take too much away from it because it has been impressive. And I would not have necessarily guessed that to be the case. Last week, Bitcoin was breaking down below its moving average. Now, I was shining praise upon it or showering praise upon it for its big move out of the gate and how it had held on to that move for much of 2023. But finally, it seemed like last week it was giving up the ghost and had given back much of those gains. So, I was not necessarily as enthusiastic about it last week as I would have been the week prior to that, because it looked like it was going to start breaking down. Well, my oh my, was I ever surprised when one of the things that was happening over the weekend, in addition to, the regulators coming out letting us all know how they're going to handle the Silicon Valley Bank situation, is Bitcoin was ripping over the weekend. And so, I'm sure that's not a coincidence. I'm not a huge Bitcoin guy myself, so I don't know exactly why that would be. But, when there is a distrust in the traditional financial and banking sector, perhaps that is a moment in time where people start opening their eyes to Bitcoin as an alternative to that traditional structure. And maybe there's more to the story than that, but that would be something just off the fly that I could, maybe buy into as to why the market itself is reacting the way that it is to Bitcoin. Whatever the reason it has been aggressive. We went from being below 20,000 to being above 25,000 in basically a heartbeat. It only happened over a series of a few days. Remember, Bitcoin trades over the weekend. Unlike the stock market. So sometimes you get a little bit of a feel, even on like Saturday or Sunday, what might be in store for things. But I would say that in general, that's a healthy sign. I'm not here to say any of you should be bullish or bearish Bitcoin. I'll leave that up to each one of you as individuals, as you'll all think about that unique asset class differently. But I'm just here to say in general, it suggests that risk appetite is pretty good. And helps us maybe feel more comfortable about the situation as opposed to the opposite if it were torpedoing lower. So anyway, we'll keep our eye on that, but all of a sudden we do have Bitcoin looking pretty strong, hitting yearly highs here today, or at least I should say year-to-date highs here today. And you can see that it does have a light green background color telling us that we have a weekly bullish posture, and we do have price above a rising moving average with that green 30-day moving average line there as well. So those are bullish features. So just when it looked like Bitcoin was going to go out and be devastating for those that hold it, boy oh boy, was that turnaround aggressive, and it happened in a hurry here. So let's keep our eye on that. That's been a very, very interesting situation that I don't think a lot of people were necessarily expecting to play out the way that it has. Let's now talk about those lower two corners that are still very important to us. So in the lower right-hand corner, we've got the 10-year Treasury yield. We had a big snapback in that here today. Now, like I was mentioning on Twitter yesterday, Treasury yields have just collapsed in 3 days. Part of the reason behind that is the market is now convinced that the Fed will not be raising by 50 basis points. And remember, just a couple of weeks ago, it was almost a shoo-in that that is exactly what was going to happen. But that was before this banking crisis. So it just takes a little banking crisis to turn what appears to be a hawkish Fed into a dovish Fed. Now, it's on the flip side of that conversation where Goldman Sachs is coming out and they're saying there's a pretty decent chance the Fed does not raise at all here later on next week. So it's not just 50 down to 25 basis points. There are legitimately people out there that think the Fed is done raising interest rates because of this chaos of Silicon Valley Bank. So naturally, that's going to work its way into the Treasury yield market. And that's why we saw this complete collapse of yields here in the last 3 days prior to today. And that's why we've seen, some of those interest rate sensitive areas like bonds and utilities and REITs and, some of the other areas do a little bit better here recently compared to before, because we've seen a little bit of a give back there in interest rates. But today we did snap back in the other direction, perhaps as a response to that CPI that I had mentioned before. So we'll see where things shake out, but it has been aggressive, not just in the financial world, but also within the bond world and within the interest rate world in terms of how the bank crisis has affected these different asset classes. So naturally, on a day when interest rates are up fairly aggressively, closing at 3.63%. Remember, just a few weeks ago, we were above 4%. But today is a nice move higher off of yesterday's lows. So the opposite of that happens to bond prices themselves. No surprise there to see TLT give back its substantial gains that it had yesterday, but still manages to find itself above its 30-day moving average here all of a sudden. So as you can see, TLT is actually trading pretty much exactly in the middle of its 3-month range at this exact moment in time. So some of you might look at perhaps selling an iron condor on TLT as just one example. You can see down in the lower left-hand corner, we do have the US dollar was basically flat here today, and it's sitting right on top of its moving average at this moment in time, or basically right on its moving average. So this is a moment where it's just sitting there trying to figure out what it wants to do. Does it want to break through the moving average, or is there a chance that we bounce up and off of it? And a lot of that will be dictated by what happens with risk appetite. If we get another day like we experienced today in the stock market, my guess would be we probably would see the US dollar break below that moving average. On the other hand, if something comes out of nowhere and spooks the market again tomorrow, whether it's a bank or anything else, then I would expect that this is a logical place for the US dollar to try to bounce up and off of. So we'll await further information there. Gold has also been very impressive, like Bitcoin here recently, perhaps for the same reasons. People are finding that they can't really trust the traditional financial system at this moment because of the bank failures, and maybe gold and Bitcoin are looked at as alternative monies. And you can see that gold really got going here in the last, let's call it, week or so. Today it was pretty flat. It was down about 0.58%, but really that's just taking a breather after the really aggressive move there. Not only did we get up to the moving average after having this oversold cluster signal, but we sliced straight through it like a hot knife through butter. And now all of a sudden we're up here filling this gap from early February. So just like that, with the snap of the fingers, some of these asset classes are changing very, very aggressively. Speaking of which, you can see oil has now fallen out of bed. Oil is down 3.5% today and touching its 3-month lows. Remember, recently I've been talking about how oil has really been just chopping sideways, and we really need to await further information about which direction it thinks it needs to go. Well, right now you got more information. Today was a breakdown day. So that's not a guarantee, obviously, but it doesn't look good for oil at this moment in time. It looks like the path of least resistance for this commodity is now to the downside. Up here on the top of the chart, you can see that SPY, of course, was up, as I mentioned before, but EFA, which is the developed foreign stocks, were up fairly nicely, up 1.33%, bouncing nicely off of their oversold cluster signal from yesterday. However, EEM was a tremendous letdown. It was basically flat today. Remember, EEM, which tracks the emerging markets, tends to move more aggressively than the developed market. So if anything, you would have thought that a big risk on day like we saw today would have seen EEM outperforming those other areas. In fact, we saw the opposite. So not a great look there, especially when you were kind of, the rubber band was already stretched pretty nicely for this move as well, where you had 3 straight oversold cluster days. So this is a tremendous disappointment with EEM. I'm not sure if there's a specific story going on there or what is causing that. All I can tell you is this is not what you would have assumed given the other information that we learned here today. So probably not a good, healthy look out of the emerging markets at this moment. Let's now take a look here briefly at our sectors. And all of our sectors were up in the United States today. So, it's nice to have one of those solid bullish days for once, as opposed to all of them being down like we saw on a handful of occasions here last week. But despite the bounce backs that we saw, there are only 2 charts down at the bottom, defensive charts at that, consumer staples and utilities, that have weekly bullish postures. All the rest of the charts, despite today's rally, still have strongly bearish charts. But of all the rest of the charts, the one that I think is setting up the nicest right now is technology. You can see at least in this case, while it still has the strongly bearish posture, it's at least trading above the rising 30-day moving average right now, and no other sector can make that claim. So technology does seem to be a leadership group, somewhat of a safe haven in this very chaotic market that we've found ourselves in here all of a sudden. All right, let's get into the trade application example now. And I'm going to pull up a stock called Fiserv, and let me show you this in a bigger chart here. So this is ticker symbol FISV. Now, this chart is actually not a stock that is in the financial sector, but it is an ancillary play of a company that helps banks with software and other, technology and consulting and different things like that. And I had heard, and you'll want to confirm this for yourself because I just heard this through the grapevine, but I had heard that that FISV, Fiserv, one of their customers was Silicon Valley Bank. Now, I don't know how big of a customer they are. I don't know if it's a big deal or not. I don't really need to know that information because I'm not taking some sort of a long-term bet one way or the other on this particular stock. All I'm doing is making a bet for the coming month because basically I'm trading options on it. But just wanted to throw that out there because some of you might otherwise be wondering, well, why is this stock cratering the way that it was last week when it's not a financials company? It's because its end market are financial customers. And so like a lot of the banks, it snapped back here today. As you can see, it was up 6% here today. However, you basically closed today's candle within the body of yesterday's big sell-off. And clearly, we still have, a bearish intermediate posture. Now, interesting, the blue line is bullish. It came out of the lower reversal zone, but the green line is still in that bearish territory, which is why we see that pink background color up here on chart 4B in this case. So this one was a little bit more hit and miss. I'm not sure if it's really ideal, but my thinking behind it was I wanted to get some more bearish deltas in my portfolio. You guys have probably noticed over time that I tend to feel a little bit more comfortable doing bullish things like selling puts on big sell-off days. And likewise, I'm also comfortable doing bearish things like selling bear call spreads on big up days for the market because I feel like my pricing is better if I can, successfully navigate that choppy type of condition. Now, obviously, I'm going to be wrong plenty with that as well. In fact, I think there's an iron condor or two that I'm going to have to lick my wounds on in this particular option cycle. And by the way, for those of you that are premium members, keep your eye on Telegram. I might very well shut down some of those trades before I leave on my trip. But anyway, I wanted to get some more bearish deltas into my portfolio, so I was intentionally looking for some bear call spreads here today. And many of the bear call spreads have already broken, or so many of the charts have broken down so aggressively that I wasn't really feeling all that comfortable with them. This stock had actually been doing well before the banking crisis, so it required the banking crisis to kind of break the stock. And now all of a sudden it kind of feels like, if you want to take the apartment complex analogy, you might have been bouncing up here on the top floor, and then all of a sudden there was a hole that you found in that wooden floor, and you just plunged to the next level of the apartment complex. It's really hard for a stock to jump back up into that prior level, just like it would be hard for a human to jump up into that other apartment complex above you if you happen to fall through the floor. So that's kind of the idea that this is a real broken chart here. It might very well, prove me wrong, but the nice thing about doing a bear call spread or selling a bear call spread like I did in this case is I have defined risk. What I did was I sold the April 115, 120 bear call spread, meaning that's the 115 strike that is the driver of the trade. I received $1.30 for it, so it gives me a break even on this trade of $116.30. So what I want for this trade is for this stock to stay below 116.30 between now and the April expiration cycle. So I've got about a month to be in this particular trade here. So we'll see. My hope is that now that it's cracked through the moving average so aggressively to the downside, that will be used as some sort of a resistance moving forward. And of course, if we have a follow through of any more potential bank chaos and other banks go down in the future, then this company probably would struggle right alongside them. So if I'm wrong, again, and it rips above 120, I've got a built-in hedge with a bear call spread. I'll still lose money on the trade. I just won't lose more money if it goes above 120. But ideally, I want this thing to stay below 116 and kind of keep with this recently turned intermediate bearish posture that we see here on the chart. Okay, so that's what I had for you here tonight. If you enjoyed the presentation and you got some value out of it, I have one simple request out of you. It doesn't cost you a penny and it only takes 5 seconds out of your time. Simply click like for me there on Twitter, and I will be sure to do another full-length video for you when I'm back with you a week from today. Remember, I won't be with you on Thursday, but next week I'll be happy to do a full-length video on Tuesday. Otherwise, if you want me to keep it nice and short, I can do that as well. And don't click like if that is what you prefer, and then we'll just have a 15-minute version there for you the next time around. So we'll let you guys decide collectively there, but I want to thank you for tuning into the video tonight, regardless of whatever your decision is in that regard. And I want to wish all of you not only good luck with your trades and your investments like I normally do, but I know a lot of you are college basketball fans, and perhaps your favorite school is in the tournament this year, so I'll wish you all a little bit of good luck in that regard as well. It should be another fun weekend as we head into March Madness here. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.